Welcome to the retirement stage. This is Dale Roberts, the Chief Disruptor at Cut the Crap Investing. In our first Zoom meeting, we realized that building wealth should be one of the most rewarding and stress-free things we do in life. We simply buy growth assets on a regular basis, save a lot, invest a lot. Retirement is more complicated. In retirement, or the decumulation stage as we call it, we're looking to maintain enough portfolio growth as we protect enough wealth at the same time. The appropriate retirement portfolio plays offense and defense. Stocks and REITs for growth, bonds and cash and annuities for defense. And we can throw in some dedicated inflation fighters as well. The reason for that is a series of bad years for stocks and REITs at the beginning of your retirement stage could impair your portfolio. We need to greatly respect those bear markets. We call that sequence of returns risk. Here's a retirement funding example. That is to say the portfolio is delivering income to the retiree. The all-stock portfolio in blue is severely impaired during the great financial crisis of 2008 to 2009 and beyond. The balanced portfolio with a nice mix of stocks and bonds declined much less and recovered much quicker. In retirement, we might follow the safety first rule. You can manage the sequence of returns risk by holding enough defensive assets. In fact, you could remove the sequence of returns risk entirely by holding a very defensive portfolio. You have then replaced the sequence of returns risk with the risk of not meeting retirement goals. Your portfolio might not offer enough growth. We need balance. A simple balanced portfolio, that is the traditional well-balanced mix of 60% stocks and 40% bonds, historically got the job done for retirees in most periods. The balanced mix offered the ability to fund retirement needs for 3 decades or more. And as always, past performance does not guarantee future returns. So how much do we need? Retirement planning is based upon a rule of thumb called the 4% rule. The guidelines suggest that with a sensible retirement-ready portfolio, you can spend 4% or slightly more of the portfolio value each year adjusted for inflation. And that rule is based on a 60-40 balanced mix. For example, a $1 million portfolio would deliver $40,000 of annual income adjusted for inflation. We won't always use the 4% rule, but it does offer you a ballpark on how much we need to save and invest. And of course, you will factor in taxes as well. On Cut the Crap Investing, I offered up for consideration a 7 ETF retirement portfolio. In place of the large cap Canadian and US stock market ETFs, I used a high dividend ETF for Canada, that's Vanguard's VDY, and a lower volatility dividend growth ETF for US stocks, Vanguard's VIG. I also added REITs, real estate that is, and you'll find a slice of BMO's monthly income ETF. Keep in mind the above is not advice, but a demonstration of a simple retirement portfolio mix. Inflation is stealing the headlines these days for the first time since the 1970s, hence the Beetle camper van image. Investors might choose to add dedicated inflation fighters. While stocks historically deliver returns above inflation over many decades, they don't always work in the moment when inflation is raging. They don't offer returns that match unexpected inflation or stagflation. It is a personal choice. I employ gold and real assets plus oil and gas stocks. A simple solution is the one-stop purpose real asset ETF, ticker PRA. If you want energy stocks, there are index ETFs such as iShares XEG or BMO's ZEO. You might consider at least a 10% allocation, and to make room for the inflation fighters, you can trim equally from the stock and bond assets. Many retirees feel more secure if the retirement spending needs are covered by dividends and other specialty income. It is true that if you need your portfolio to fund at a level of 4.5% and the dividend yield is 4.5% or more, you have eliminated the sequence of returns risk. That said, the retiree might be sacrificing sector and geographic diversification, and there's no guarantee that the dividends will keep growing or even hold steady in times of bear markets. I'm a fan of the hybrid approach, where generous and growing dividends are part of the total mix. but the dividends are not the sole focus. We will save this discussion for a dedicated video and Zoom call. Another way to manage sequence of returns risk is to have a variable withdrawal strategy. When times are good, spend a little more. When times are bad for markets, spend a little less. Think of them as guardrails for retirement spending. Many planners suggest that you would reduce spending by about 15% when markets are getting hard, and I will write a dedicated article on this strategy. Your portfolio is just one piece of the puzzle. You might also have income from government pensions, private pensions, real estate, inheritance, home sale, downsizing. You might work part-time. It can be a bit of a retirement funding puzzle, but it's not hard to get the pieces in the right place, and it's not difficult to discover the optimal order of asset harvesting. I'll offer up one of the considerations for the order of asset harvesting. You're eligible to take CPP at age 60, but if you delay your Canadian government pension until age 70, you could receive a payment boost of 42%. You would use other assets, such as your portfolio, to fund retirement to age 70. So do you take funds from RRSP, TFSA, or taxable? Our friends at Cash Flows and Portfolios help self-directed investors discover an efficient order of asset harvesting. That is, what account types do you draw from and when? At times, it may be more efficient to NRT, that is, spend more non-registered dollars first, then RRSP, and then tax-free. You might be better off with RNT. You first pull from RSP, then non-registered, and lastly, TFSA. Every retiree is unique. Every retiree will require a tailored solution. Don't guess, get help, get a plan. You might have several or more sources of income, and there are a lot of moving parts, plus tax and estate considerations as well. The expertise required is outside the bounds of a typical self-directed investor. It is very important that you seek help. You might consider an advice-only planner. You can pay a one-time fee. You don't have to hand over a portion of your retirement portfolio on an ongoing basis. Fees are always important, but consider if you need your portfolio to fork over 5% annual and you're paying an advisor and a mutual fund 2% in annual fees, you're losing 2/5. 40% is going in the wrong pocket. You can check in with the folks at Cash Flows and Portfolios and/or pay an advice-only planner and then move on to manage your own investments in a low-fee manner. This video is a basic overview of the retirement stage. Your key takeaways might be that fees are important and you can build a successful retirement portfolio, but you will need help in other areas, and that will be money well spent. Feel free to send me a note and I can pass along some options for advice-only planners. Check out Cut the Crap Investing for retirement-focused blogs. Also, make money sense and Cash Flows and Portfolios a regular stop. And thanks for watching.